Let's say you wanted to short Tesla using stock options. I know, it's crazy. You're thinking Tesla shorts have just gotten absolutely destroyed this year, but let's say you're really convinced that it's a bubble and it's going to come down. Well, if you traded just options, because the price of Tesla stock is higher, that means the price of the options are also pretty high for someone with a smaller account. So the question is, okay, if I have a smaller account and I want to trade options, how do I trade Tesla? Because hey, the options volume is great, the liquidity is great, and I want to use it as a trading vehicle. Well, that's where something known as spreads comes in, and in this video we're going to talk about credit spreads, which is one way to play the downside using options with less capital, and it can provide a way to play volatility as well. So in this video, we're going to talk about just bear call spreads, or also known as credit call spread, short call spread. They're all the same thing. Basically, it's a limited risk, limited reward strategy that can be used where you don't have to use as much capital. So really the trade involves purchasing 2 call options on the same expiration date. And basically what you're doing is you're selling the closer to in the money option, and then you're buying the further out of the money option. Now what that does is selling the in the money option is more expensive, and buying the out of the money option is less expensive. Basically the difference between those two is what you collect up front, and then the hope is over time what you collected. Let's say you sold a spread for $2, you can buy it back at a lower price. So that's essentially what a bear call spread is from just a definition standpoint. This is just coming off of Investopedia. Now, further in this video, I'm going to go over a specific example with Tesla. So you can see real time kind of how it looks like in the real world versus sometimes you look at this mumbo jumbo and you see a bear call spread with this chart. You look at that and you have no idea what the heck that means. So let's get into it and let's talk about Tesla specifically. So I use Tastyworks when it comes to trading options, which makes it pretty easy to implement these strategies with a couple clicks of the button. If you use something like Robinhood, it's going to be a little bit more manual and not as simple to set up. But with Tastyworks, you just type in the ticker symbol, come to strategies, click on this vertical short call spread, you'd click go, and you want to do that for a specific expiration date. So for this one, we have February 19th, 21, and we're shorting the 995 call and we're buying the 1000 strike call. Now the difference between these two is the spread. So we would call this a $5 wide spread. And as you can see, when we're combining these two, right now it says, the mid price of this spread is $1.28. Realistically, when the markets are open, you can see that it's pretty wide between the bid and ask. So it'd probably tighten up and the price may be a little different. So if you clicked review and send, you would see the kind of max P&L right away. So for instance, if you did sell it at that 128, which wouldn't be a great price in my mind, but essentially you're saying max profit 128 and your max loss is basically what you collected, right? So you collected $128 and the width of the strikes was $5. So you would basically take 500 minus what you collected. So 500 minus 128, your max loss would be 372. What's also nice here is that you can see the amount of theta that you're collecting on a daily basis. So this means that for every day that passes, as of now, you would collect around 50 cents of theta decay. What else do you have to pay attention to when you're selling these spreads? First of all, the volatility of the underlying asset also determines the price of the spread. So you can see metrics up here. This 27 represents implied volatility rank. So based on a yearly historical average of implied volatility, this is right around the 27 percentile, in terms of implied volatility. So 100 would mean it's at its highest point of implied volatility for a yearly range, and 0 would be it's at its lowest point. So for me, a personal preference is selling credit call spreads or credit put spreads when that number is above 30. Now, the other thing that may be determining the price of the spread is obviously the delta that you're selling. So currently Tesla is at 880, right? And the short spread short strike that I chose was 995. So this is an out of money spread. Now, if you move this up and you made it right at that 880 strike, this would be more of, okay, this is at the money. This is an at the money, and you would collect more money. And then if you go further, you'd be in the money and you collect even more premium. So the further out of the money you are with your spread, you're going to collect less money up front, but your probability of profit on that trade goes up, and it's vice versa. So if you collect more money on your credit spread, the probability of profit is less, but you've collected more. So that's kind of the trade-off between where you select your strike prices for your actual spread. When it comes to my personal preference on how to trade these spreads, I go to the 30 delta, and then I'm also usually selling the monthlies because they have more option volume and they're a little bit more liquid. So I'm looking for the monthlies. I like to trade anywhere between 30 and 60 days, and then I'm trying to sell the short strike at 30 delta. And usually the kind of rule of thumb is if you take the spread, so in this situation there's only $10 wide spreads, you would take that, so $1,000, and multiply it by the delta. And if you can collect around $300, you're not, in my opinion, getting ripped off, or you got a relatively decent fill. So that's kind of like my rule of thumb. If you can collect more than that, that's great. But that's kind of what I use as a proxy. Okay, so let's go back to the original spread and talk about two ways that you make money. First, let's talk about theta decay and if the price of the stock stayed at 880 or anywhere below 995. So in this situation, the short strike that you sold, no one that bought that put option would exercise it because the price of the stock is lower than the strike price. So no one would sell at $9.95 when they could sell at $8.80. And then you bought the $1,000 strike price put, it goes the same way. You wouldn't sell at $1,000 when you could sell at $8.80. So that's one way that you make money. These both expire worthless, and you basically keep the money that you collected up front. The second way is the implied volatility here. Actually here, 91.8. This goes down, and the price of the options both go down. So let's say one day IVR is at 27, and then the next day they crush implied volatility. This comes crashing down to 70, whatever, it lowers the IVR, and the spread that you just sold that was 128 all of a sudden is at $1. Well, you can buy back that spread for $1 and make the difference and make $28 and close out the trade. So that's the two ways. Basically theta decay and then implied volatility contraction. So if you're looking at this Tesla chart and you're saying, okay, on the weekly RSI is 83 and on the daily also 83, and you want to short this thing, good luck to you. It hasn't worked all year. It's been an absolute missile to the upside. But from a short-term opinion, for me, I would actually be okay with the risk reward for a short-term downside trade here, just because we're at crazy elevated levels on a short-term basis. That's just me. Maybe I'm crazy. Definitely not going to buy any longer-term puts or anything because this thing could stay elevated. Fundamentals could catch up to the actual stock, but I think it's due for a pullback for a short-term trade. I like the risk reward, the pot odds, so I don't mind it. Hopefully you found this video helpful and you know a little bit more about credit spreads and how to use them effectively and my personal take on them as well. So if you did enjoy this content, please consider giving this video a like or a thumbs up and consider subscribing to Main Street Wolf. Thanks guys for watching, and have a great day.